Boris, thank you so much for joining us here on this day after Christmas. It's been a record run. You heard 9 straight record closes for the NASDAQ Composite. We haven't seen that since the .com era. Does this market feel bubblicious to you?
It does. I mean, that's actually an ominous statement, I think, more than anything else, that since the .com era, since you and I are probably old enough to remember to survive that .com era, that I think, when you look at the market right now, almost everybody agrees that the real reason here that that equities have really run up is not a fundamental driver, but the fact that Fed turned very much toward an easing bias as we started the year. And the big question to me as we go into the next year is, what is the Fed going to do after the 31st of December? It's already pumped $500 billion, $500 billion into the repo market since September. Are we going to go at this pace next year, which means we're going to expand the Fed balance sheet by $2 trillion in order to keep the repo market pacified? That's obviously very positive for equities for now, but just as equities have really risen, not any fundamental reason, but because of monetary phenomena, I think it's very possible we could have a relatively steady economy and a market decline if the monetary policy somehow flips, or if there's some kind of a crisis action in the capital markets. So I don't think, the idea that we're divorced from the fundamentals on the upside could also mean that we're going to be divorced from the fundamentals to the downside as well. There's a possibility of a market crash without necessarily a possibility of an economic crash as we go into 2020.
I mean, can the market really crash, Boris? Can it really crash if there are still central banks standing ready to provide trillions of dollars worth of quantitative easing, financial monetary stimulus, anything like that? And if that's the case, does that make central banks, including the Fed, the central storyline above everything else in the year 2020?
Absolutely. I mean, I think that's the one key thing almost everybody agrees on, whether you're bearish or bullish, that it's really the central bank story that's going to drive a narrative going forward. The key question is, I don't think anybody really knows how long the central banks can prop up the capital markets at the pace that we're going. I mean, a lot of what's going on right now, everything I read about the repo market basically is telling me there's 3 things that are going on right now. It's either a situation of too strict regulations. It's either a fact of the fact that we're just financing the deficit. We have huge amount of supply coming up now as far as deficit financing. It all gets financed in repo. Or it's some kind of a collateral problem that the Fed is trying to paper over. And that, I think, is the big unknown. If there's some kind of a collateral problem in the repo market, it doesn't matter what the Fed does. It's just a matter of lack of confidence. If there's some kind of a lack of confidence in a market break, that's the error that we could have. Now, I'm not arguing that we're going to have this, and I think it's very, very hard, as you said, to kind of bet against the Fed, but I do think investors have to be careful. And the most interesting thing that's been happening over the last 48 hours has been this unbridled run in gold. That's been a stealth rally that I think nobody has any paid attention to. We've had gold now take the 1,500 level over the last 48 hours and hold it very, very steadily. I've been watching this market tick by tick. That tells me somebody else in the market is watching what's going on and is kind of hedging their bets. So I think at very least investors should be following the same thing, which is to hedge their bets either with some put options or maybe as a gold as a diversifier, because there could be a break, and and you certainly want to have some protection.
All right, you mentioned this idea that you want to hedge a bit now. It's fair to say that given perhaps a little bit of the lack of volatility in the marketplace, that hedging protection, that insurance for both the upside and downside in markets is relatively cheap.
Yes.
Does that then mean, Boris, that there is a healthy amount of complacency out there with regard to the overall investment environment?
Honestly, Dom, I've been around like you, I think, for a very long time. I've never seen more complacency since 1999 in the markets. I know everybody's saying it's not true, but if you look at, for example, the CNN Fear Greed Index, it was at 3 during the global financial crisis. It's at 94 now. It's literally the mirror opposite of when we were all fearful. Everybody is greedy at this point. I don't think you can be. And I think whatever other metrics everybody is pointing to is saying it's not overbought, the individual investors' numbers are not as bullish as everybody thinks. I think they're kind of false. If you really read the basic Wall Street consensus, everybody who comes on your shows is basically telling you it's 10% up to the upside. There's nobody saying that could be a market crash next year. That, to me, tells me that there's tremendous amount of complacency in the market at this point.